What's up, everyone? I'm very excited to announce our new show, Full Signal. I'll be hosting it every single week, and our first episode today is with Mike Green, the chief strategist of Simplify. We talk about the biggest risks in the market today, how passive investing might be creating an everything bubble, and why Bitcoin is not the investment vehicle you might think it is. I hope you enjoy this conversation. Mike Green, thanks for joining us today. I know you've been bearish on the economy and markets for most of this year, and we just had a Fed rate cut. Stocks are at record highs. Give us your lay of the land here.
Well, first of all, thank you for having me. Secondly, I think it's important to distinguish between being bearish on the economy and bearish on markets, right? So one of the things that I've been very clear on is that as long as flows into passive vehicles, as long as Americans have retirement plans and the majority of the assets are being allocated to passive vehicles, that what many describe as that mindless robot is effectively sucking stocks up, right? We have price discovery in terms of where transactions have to happen. It's really not telling us anything about the state of the economy or the actual behavior of the individual securities as much as it's telling us about the flows that exist in the market. So I just want to make sure that it's very clear that it's, bearish on the economy and bearish on the stock market are two very different things.
Explain how potentially inflated asset prices might be masking some of these risks in the economy.
Well, I don't think it's just masking. I actually think it's contributing to the behavior in the economy. So just very quickly, you are somewhat familiar with the work that I've done around passive. The idea is very straightforward. How we invest actually influences the outcomes that we see. And approximately 20 years ago, the United States and its retirement plans settled on the idea that the safe, rational investment for people to buy was the index fund. And when you buy an index fund, you're buying a market cap weighted index. Most people think that means that it should have no real impact. And the actual definition of passive investing is somebody who never transacts, who always holds. Right? That's the theoretical academic definition of it. The problem is that in order to get in to hold, you have to buy. And in order to get out, you have to sell. And so you're not a passive investor at all. What you are is a systematic algorithmic investor in which you've chosen a particular methodology for how to invest. Now, the problem is because it is market cap weighted, and market cap doesn't necessarily scale with liquidity. A company like Apple is 100 times the size of a smaller stock in the S&P 500. It probably only has about 10 times as much liquidity. And so when the large orders go in to buy something like an Apple or an Nvidia, they're pushing that price up more than they are other stocks. As they become larger and larger within the index, they receive more and more of that allocation. It creates a spiral effect where both the flows and the concentration actually feed back to create the behavior that we're ultimately seeing. We have a machine, we've given it a job. Buy stocks when I give you money. What stocks should I buy? The ones that are in the index. At what price should I buy them? Whatever price is available, right? And that creates an inflation that ultimately pulls stocks, and has pulled stocks far above fair value. Most people will observe this and think that it's tied to some form of mania. I think it's much more frightening that it's really tied to Americans who are not thinking about their portfolios, who are simply engaged in the behavior that we've been told makes sense, which is to dollar cost average in at higher and higher prices. That makes us feel good. It looks like our wealth is inflating, but unfortunately, it's largely a mirage.
Is there some sort of tipping point that you anticipate? Because I know passive investing is about 50% of the market, or a little over
50. It's a little over 50% now.
Over 50%. Are we going to get to some point where something breaks because of all this passive investing?
The quick answer is yes, right? Finding that point is actually quite hard because, among other things, as passive investing grows, what's called the competitive response, right? The reaction to those overvalued securities are supposed to cause people to be more aggressive in selling them. That theoretically would increase the supply and push the prices back down. But as the passive share grows, the proportion of investors who can actually react to those prices and stand in opposition to it shrinks, right? Shorts are largely an extinct species on Wall Street at this point. Most value managers are also extinct simply because valuations have been lifted far above what they would consider to be rational. And so they are naturally hesitant in a market that has taken on runaway characteristics, as you might expect with those feedback loops.
How come you don't think more investors are aware of these passive investing risks? Because most of the people I know, they have work-related retirement accounts, and all their extra capital goes into these index funds.
Yeah, that's the answer, unfortunately, is that what we have been taught is that it is passive investing, right? That we ultimately are just participating. You can't actually just participate. You are an active participant in the market. You are making a buy decision, even though you've outsourced it to an algorithm. So the simple answer is that we've done a disservice over the past 20 to 30 years. We didn't actually understand how the market reacted to flows. My work began in 2016 with the release of a paper called Sharpening the Arithmetic of Active Management by Lasse Peterson that addressed the Bill Sharpe paper from 1991 called The Arithmetic of Active Management. This is the source, that paper is the source of all the language that you'll ever hear that says active and passive ultimately own the same things. And as a result, the only difference is the fees. So we should all pursue lower fee investment process. Turns out that's not even remotely true. And it's also not true that the market can absorb those inflows in the same way that we had assumed from academic theory, right? And this tends to be where things go wrong. It's just that we build a model of the world, we engage in particular behaviors based on that model, and it turns out the model is wrong. Home prices can't go down. They can't become correlated on a national basis, right? Granting people mortgages is not going to increase the propensity across different cohorts to default at the same time, right? We know those assumptions were wrong because we lived through the global financial crisis. Now, unfortunately, I think we're going to find out that our assumptions were really wrong about how the stock market works. And unfortunately, since I began doing this in 2016 and communicating it broadly around 2018, we've actually seen the academic work that is now beginning to emerge to give us the math to explain all of this. And unfortunately, it has all reinforced the points that I've been raising for over a decade now.
Can you give us an example of some of that math that you're talking about?
Yeah, I'll give you a really simple example. One was the example I gave on liquidity not scaling with market capitalization. And so the price impact is a function of liquidity and volatility, right? How much volume is traded in a stock and how volatile is that stock? That helps us understand the impact that you'll have in a market in reaction to an order of certain size. We know this within the institutional space. Anyone who's traded large funds for a very long time understands and thinks about the impact that their individual order will have. Vanguard is very active currently going out and explaining all the steps that they take to minimize the impact that they have on the market when they place orders. And I absolutely believe that that's true. But the scale that we've now gotten these investments to is such that we're actually overwhelming the market's ability to provide liquidity. In terms of, some very, very specific examples, the biggest piece of research that has emerged and an understanding is that there's a much higher multiplier effect from a dollar trying to go into the market versus a dollar versus what we had assumed under the efficient market hypothesis. And just to put that in very simple terms, right? We know for every buyer, there's a seller. And so the academic model that existed prior to about 2021 was effectively the EMH specification that the markets were highly elastic. They could absorb almost anything. And a dollar into the market would basically just be the bid-ask differential, right? We're just going to have a spread between those two. If I put a dollar in, it basically creates a penny of market capitalization. In 2021, a paper came out by Gabay and Koyjin, Xavier Gabay at Harvard, Ralph Koyjin at Chicago. And they articulated that number actually appears to be between $5 and $8. So instead of a penny of market cap being created when a dollar flows into the market, it's somewhere between $5 and $8. That degree of inelasticity completely changes the working models for how passive investing influences markets.
So if let's say your view right now is that passive investing is inflating asset prices. If I were to come back to you and say, well, look, earnings have been growing, these businesses are generating real profits, the market is strong on a fundamental level, how would you counter that?
So I'd point out a couple of things, right? One is that, first of all, I would dispute the earnings quality. We're actually starting to see more and more evidence that the companies that are being inflated by the AI framework are largely circular in their revenues. Microsoft makes an investment in OpenAI. The investment actually takes the form of Azure credits that can be used to drive up the utilization of Azure. And unsurprisingly, Microsoft is reporting fantastic growth in Azure. But if you look below the surface, the actual cash that is coming in has deteriorated markedly for these companies, whether it's Microsoft or whether it's Meta, which in particular is fighting for its life with a largely static and increasingly irrelevant product mix. They basically have come out and told you, we would prefer to go bankrupt than miss this opportunity. The reason they're doing that is because their security is overvalued. The equity is overvalued. They're trying to protect that value, right? They're getting signals from the market that says their business is far more valuable than it actually is.
So you think the fundamental story is also...
I think the fundamental story is fundamentally misunderstood, right?
Okay.
At the same time, when you think about the type of extraordinary profit gains that have occurred, a company like NVIDIA, which has done extraordinarily well and has become really critical in terms of how we think about our day-to-day existence of certainly what it'll look like in another 5 years, that company has seen its gross margins rise from around 40% to around 75% to contribute to that increase in profitability that you're observing. They've hit levels of shipments that were candidly unbelievable several years ago. But those margins are really the thing that's incredible. And if you think about that circular framework, if NVIDIA lends to its customers so that they can buy their own products, that customer is not really going to be negotiating on price, right? So it's inflating those margins, keeping them higher than they otherwise would be. NVIDIA, has its own issues with this vendor financing type model. Many of the others that are actually being forced to invest to keep up in this race, we're now seeing the levels of investment for the Mag 7, those companies that are the hyperscalers, as they refer to them, they're rapidly reinvesting their cash in what many people believe are actually relatively short-lived assets. That suggests their profit margins, if we're properly modeling them and thinking about them, are actually quite a bit lower than they're actually reporting.
Is your characterization of the AI boom that's happening right now, what you're describing with the circular financing, do you think that's limited to just the leaders, or do you think that's pervasive?
No, look, I think this is unfortunately, and this is something we found out after the dot-com cycle. There was a very famous paper written by Michael Jensen called the Agency Costs of Overvalued Equity. And basically, if a management team is forced to defend an outrageous valuation, they're going to behave in manners that are actually quite counterproductive. They'll make lots of investments that seem immaterial at the time, but actually turn out to significantly impair both the development of the industry as well as their own performance. This is really one of the key things that came out of the dot-com cycle. When you remember companies were incentivized to spend ridiculous amounts of money on Super Bowl ads, for example, right? I would argue that much of what we're seeing is very similar. It probably ties more closely to the build out of fiber, right? So the telecom build out of fiber was very much a story that there's unlimited growth opportunities ahead of us. 2000 was the absolute peak for telecom revenues. They actually fell by 50%, even as demand for the internet absolutely exploded. It's fantastically unbelievable to me that we're going to introduce a super intelligence, right? An LLM type capability in which we all become radically smarter, and somehow we can't figure out the way to do it cheaper, right? Like, it just seems counterintuitive to what we're actually talking about. This is fundamentally a deflationary technology. It's replacing people's actions and activities and freeing up time and increasing productivity. That should be deflationary, not inflationary, which is what it appears that people are actually forecasting. The second thing is, as you grow to a point at which the law of large numbers begins to meaningfully impact you, you should be seeing lower multiples, not higher multiples, right? Your capacity for growth has shrunk dramatically versus where you are today. That should be reflected in lower multiples, not the higher multiples that people are articulating as a function of unlimited growth ahead of us.
So I watched the Fed press conference the other day, and someone asked Jerome Powell, how do you compare the AI boom to the dot-com bubble? And he said, they're not the same because these companies are generating real profits. It sounds like you're maybe going to take the other side of that. Is that true?
Well, I can take the other side of almost anything Jerome Powell says, but the simplest answer to this is yes, I think he's wrong, right? If you look back at the dot-com cycle, many of the companies that survived that process, the Microsofts, Cisco's, et cetera, of the world, were actually fantastically profitable, and profitable for exactly the same reason. Cisco was extending vendor financing to various internet service providers who were trying to build out their capacity. That left them in a position where they were not negotiating for price. Cisco had extraordinarily high profit margins. And we found that a lot of the equipment that we deployed, under the assumption that both the capacity was limited and that prices would remain high, was just wrong. And again, I think this is actually very, very analogous. I think it's super easy to forget that the dot-com was not just about unprofitable, quote unquote, dot-com companies launching web pages or various other stuff. We've got plenty of that in this market, right? We've got quantum computing and nuclear stocks, and we've got unprofitable AI companies that are talking about going public at $1 trillion valuation. So, this is unfortunately the same thing, but I would expect Jerome Powell to say nothing different.
That's fair. Talking about AI and getting more and more people into the stock market, I imagine this has come into your passive investing research, because as AI makes stocks more attractive and getting into the market is more speculative and compelling, how has that impacted these passive flows?
Well, I would say that it's affected it in a couple of ways. First, I think the vast majority of the flows that we actually experience are not thoughtful, meaning that there isn't somebody making the decision to participate. In fact, the 2006 is where the really key change occurred. We introduced what's called the Pension Protection Act, and that changed 401ks from something that you had to choose to participate in. You'd get a job, your HR manager would say, would you like to participate in the 401k plan? If you said yes, that meant that you were consenting to having pre-tax withdrawals taken out of your paycheck, so less was coming into your pocket, right? And you would then have to choose how to allocate that. My very first job, I'll never forget, I opened up my 401k packet. There's 3,000 mutual funds that I'm supposed to pick from. The temptation for a lot of people is to say, I don't have time to do this now. I'm going to just leave it in the money market fund, which was the default instrument. That meant that much of it laid fallow. With the 2006 reform under the Pension Protection Act, we changed 401ks from an opt-in framework where you had to choose to participate to an opt-out framework where you had to choose not to participate. That radically increased the utilization of 401ks. There were simultaneously incentives introduced by the government to encourage companies to offer these programs, creating tax incentives for them, as well as creating additional tax incentives for matching, which I think is a fantastic asset for anyone who can take advantage of it. I want to be very, very clear. I don't want to discourage people from investing in their 401ks, et cetera. But the most important thing that happens is when you move from an opt-in framework in which people have to choose to participate and then choose what they're going to invest in to an opt-out framework, you have to give them a default investment that basically embodies that participation. The Pension Protection Act of 2006 created what's called the Qualified Default Investment Alternative. It's a liability protected choice for corporate sponsors of 401ks. It reduces the risk to them of putting their employees into inappropriate investments. These are basically blessed, right? In the initial implementation of the Pension Protection Act in 2006, they selected what are called balanced funds, so effectively funds that are run at low cost that offer both bond and equity exposure. In 2012, that was refined to become what's called target date funds. And target date funds typically embody passive investing on the equity and fixed income side. They take very simple formulations. At a young age, they put you almost exclusively into equities and almost exclusively into domestic equities. As you get older, they glide down a path to increase your bond participation. But the really key thing that this did was it radically increased participation. So we've moved from somewhere around 20% of people participating in 401ks. Today, I believe the number is around 60% of all employed Americans participate in a 401k. That's radically increased the proportion of people who are investing in the stock market. And more importantly, about 85% of those who enter into the stock market through these opt-in or opt-out 401k plans never change the allocation from that qualified default investment alternative. And so they're effectively piling into passive investments, happy to watch the balance go higher, but really not making any decision in the process.
I think maybe the optimistic point to what you're saying is that millions of Americans have made a lot of money in the market over the last couple decades.
I think that is the optimistic take. Now the question is, can they actually get that money out? That's an entirely different question. So when you, again, the phrase Ponzi is often used, right? Ponzi's work great as long as money is being put in. And in something like a stock market where ultimately the marginal price, that market capitalization, your perception of your wealth is determined by the next buyer, right? The next buyer is ultimately that marginal price. If that's being pushed higher, that creates wealth for you. You feel richer than you actually are, because when the marginal buying shifts to selling, there's really nobody underneath, right? We've gotten rid of all the short sellers. We've gotten rid of the value managers who would be there to buy something when it goes down. Passive investing works in both directions. It's really a truly mindless algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. At what price? Whatever price I can get.
So there must be a demographic component to this, right? As everyone's buying in for years and years, as they're working for these big companies, when they're ready to retire, they can start pulling those passive funds. Is that right?
They can start pulling those passive funds, and also things like target date funds have glide components to them that slowly reduce the equity allocations from the roughly 95% that you would have as a 21-year-old starting your first job to as a 65-year-old, you're going to be somewhere in the neighborhood of about 70% stocks as you approach retirement. That will lower further into the retirement accounts, and you'll increase your fixed income participation. All of that, by the way, I think is actually perfectly good and fine. I actually think it's really wonderful that people have these tools that are available for them. It's just that the models on which they were built, just like it's a really good idea for somebody to own their own home, right? The ownership society that emerged under George Bush is what gave rise to the Pension Protection Act as well. We want everybody to participate. We want everybody to be an owner, right? Those are all good sentiments. But the impact of everybody participating and the impact of everybody becoming an owner, particularly if it's done with a thoughtless, mindless algorithm that simply says, did you give me cash? If so, then buy. What should I buy? Everything in proportion to its market capitalization. If it goes up in price, I buy more with the next incremental dollar, right? It's very different behavior than a mean reverting market, which is what we've experienced over time. And by and large, I would argue that we have confused the purpose of markets. The idea of markets are capital allocation vehicles. We're supposed to set the marginal cost of capital for the participants so that we can better understand where capital is being allocated on an optimal basis in an economy. When you decide that no longer matters, that instead markets are actually retirement vehicles, all sorts of behavior starts to change around that.
So if there's all this risk in passive investing, are there alternative asset classes that you think are a better choice for all these retirement accounts or these employer accounts?
Well, I think unfortunately that what we have seen is by and large, this has become so dominant that it's created elements of effectively the everything bubble, right? The inflated valuations, among other things, are providing wealthier individuals with the resources to buy homes without taking out mortgages. They can use a brokerage account loan at far lower interest rates than mortgages typically. It's secured as collateral against that. That's helped many young people and coming from wealthy families to obtain homes, even though home prices remain very elevated. Right. So we're seeing a level of elevated home prices. We're seeing elevated valuations and prices within the equity markets. The same mechanics play through in bond markets. There are some wrinkles around it, and bonds are better protected because they have what I refer to as endogenous cash flows. They're ultimately instruments that you know their terminal value and you know the cash flows that you're going to receive associated with them. That makes it easier to arbitrage. That's why I primarily focus on the fixed income markets. But with that said, we're unfortunately in an environment in which an extraordinary amount of wealth has been created, at least on paper. And if I choose to leverage that, which is increasingly what we're seeing, right? Many refer to it as return stacking, or as you see levered ETFs emerging. Portfolios increasingly are saying, why would you just own equities? You should own equities and commodities together, right? We're going to build a return stacked vehicle in which you can spend the same amount of money, but buy both, right? That's adding to the buying power, and it's created by the collateral of those overvalued equities.
So it sounds like we are in a multi-decade everything bubble, and that's actually a bigger risk than, let's say, the very near-term AI bubble. Is that right?
I just think the AI bubble is unfortunately, first of all, it's amazing technology. I use AI on a daily basis. It's become a critical part of my infrastructure. I like to emphasize to people, like, one of my tests for technology and how important it is how do I feel when it's taken away, right? I can turn my television off and not watch it for a week. I can ignore, my dishwasher and wash dishes by hand, and I really don't care all that much. I was just recently in Hong Kong, which is behind the Chinese firewall. I couldn't access ChatGPT or Claude or any of the tools that I use on a daily basis at this point. And I felt like I'd had my thumbs removed or something, right? It was that momentary panic. I think a lot of people feel that around their cell phone. They know exactly what I'm talking. Where did I put my phone, right? That's an indication that this has become a largely indispensable part of your life. And again, just like the fiber build out in 1999, et cetera, it has become indispensable. It's going to become a critical part of our lives. That doesn't mean they're not bad investments.
Do you think let me rephrase that. You think it's still possible that demand can accelerate dramatically, but the companies themselves do not become more valuable?
Oh, absolutely. I think that's easily possible. That's exactly what the internet cycle was, right? We've dramatically increased our usage of bandwidth and data, and we pay dramatically less for it. In the initial implementation of things like Global Crossing or WorldCom, the models that were actually built in level 3 communications with their infrastructure build out, the original business models embodied the idea that data was more valuable than voice. And voice was priced at $800 per megabit, and therefore we were going to be able to have effectively unlimited demand at much higher prices. That's what drove the build out for the dot-com and the telecom cycle. It turned out that $800 today, I believe, is around 37 cents. Right, so the expectations for where pricing was going to be were slightly off. Because of that collapse in prices, we do use it on a continuous basis. We stream video. This will be streamed over video, right? How much would it have cost us to do this in 1990? An almost unfathomable amount. And as a result, we wouldn't have done it, right? So Jensen's paradox, right? As the technology develops and it becomes cheaper, we use more and more of it. I think AI is going to follow the same path. It's just a question of whether it can generate a return for investors.
I think that makes sense. I want to pivot to Bitcoin. I know you got a lot of thoughts on Bitcoin. Yeah. Can you give us your, let's say your latest view and your criticisms on the asset?
Well, I think the most important thing to understand is that Bitcoin has marketed itself as multiple different things to try to appeal to investors at various points in time. The initial implementation under the Satoshi white paper was a peer-to-peer payment system. The idea being that our payment systems, the rails of the payment systems, ultimately depend on the banking system. And so by moving to a distributed ledger and a peer-to-peer system, we'd be able to get banks out of the system, right? That's been a total failure. There are almost no real transactions that are occurring in Bitcoin. We have tons of transaction activity in speculative markets trading Bitcoin. But the actual quantity of retail transactions or peer-to-peer payments that occur over the Bitcoin network are remarkably small. And I'm sure every Bitcoiner out there can tell you the anecdote of, well, I transferred $1,000 to somebody else, right? It's an immaterial component of its utilization. The second component is you have to understand that Bitcoin was born out of a philosophy coming from the global financial crisis, the crisis that was created by banks by the overextension of credit. The banking system ultimately depends on credit. We talk about the expansion of the money supply, that money printing is occurring, et cetera. There's two types of money printing. There's money printing that comes from the government, in which they largely are trying to smooth over mistakes that have been made, right? We make a mistake around COVID. We need a whole bunch of money to pay people so that they don't starve to death when we shut down the economy. We make a mistake when we decide that the housing market is extraordinarily robust and can accommodate any amount of credit that has been extended. As that credit defaults, it ultimately shrinks the collateral that's available, destroys wealth that people believe that they have. They shrink their spending in response to it. That means other business models now start to fail. And the government basically creates a do-over by printing money. The more frequent type of printing money is the extension of credit. You go to the bank and you say, hey, I'd like a loan for $1,000. They give you $1,000. They didn't actually take the money out of somebody else's account. They simply created a new account for you called your checking account that has $1,000 in it because you've been approved for this loan. That expansion it's totally normal and it has a credit function associated with it. But Bitcoin destroys the ability to do that because it was intentionally designed to skip the banking system. And so it is effectively just a monetary system where what you're really seeing as Bitcoin is effectively the tokens that are paid to the accounting firms that keep the blockchain in order. That's really every Bitcoin that's out there is basically a payment to Deloitte and Touche, right? We're going to continue to do the accounting for this. In exchange for that, you're going to give us a shrinking share of new coins. Because you can't extend credit in that framework, right? No new money can be created. There is no capacity for mistake forgiveness in that type of framework. It ultimately becomes very limiting. Interest rates and credit spreads are just too high for a real economy framework. And that's by and large what we've seen. It hasn't emerged as a payment system. It hasn't emerged in any meaningful economic context, despite the fact that the asset has appreciated dramatically. The other issue is because we have a finite quantity of it, ultimately, that means everybody who is born after the Bitcoin have been released finds themselves in deficit in a manner that you would basically be a serf living off land in the 14th century that didn't belong to you, and there was no other land that would ever become available to you because you actually couldn't acquire it. It creates a deeply unequal society. This is something that I recognized very early on. And to be clear, I was an early adopter of Bitcoin because I thought it was actually a really interesting idea. What happens if we decide that we have private money? The problem is if you run through the simulation, Bitcoin, because there is a finite quantity of tokens, means that it basically plays like a monopoly game. Right? There is no entity that can accommodate unlimited growth. You can't add additional players as the game is being played in Monopoly because they're just going to lose very quickly. They don't have any of the properties. They don't have any of the money, right? And so they're going to be losers in that system over and over again. How does every game of Monopoly end?
Someone wins.
With a single winner. And that's exactly what we've seen within Bitcoin. We've seen increased concentration of Bitcoin in absolute defiance of what the Bitcoiners all argue, that it was divisible and that everybody would end up getting it, et cetera. What we've seen is a Gini coefficient, that measure of inequality in the Bitcoin world, that is beyond anything we've ever seen in the real world. Right? It's a system that ultimately collapses upon itself and locks people out. Far from democratizing access, it does the exact opposite.
Mike, I think you've given me a lot of homework to study up on. I
Sure.
really appreciate your time. Thank you so much.
Thank you for having me.